Well, good morning. Welcome to Dornbush Download 26 or 27. I need to get on top of that. Numbers aren't our thing. Anyway, good morning, Andrew, Dan.
Hello.
And we're talking lots of things today. Probably one of the things we're talking about is interest rates. Dan, no change by the RBA.
Yesterday.
Bit of a surprise. Share market dropped 60 points on the back of that.
A lot of economists were calling for it, don't they?
11 out of 17 picked it, but that's why you don't have too many rich economists either, because they obviously got it wrong. But look, in all seriousness, it's either going to be next month or certainly by May. We're definitely going to see another cut, because that economic data that's coming out is pretty ordinary at the moment.
The purchases managing index yesterday didn't look so good, did it? So there's a few issues there.
The GDP numbers today, we came in, the expectation was the Australian economy was going to grow by 2.7, only grew by 2.5. So we're below trend growth, so just another reason.
And I see the actual inflation rate on the RBA website itself is 1.7. They want 2%, don't they? So.
And we've spoken before about deflation. Deflation is a real problem for the Reserve Bank. So interest rates probably going to go down again. And I guess the key thing from that point of view, from a share market point of view, what that therefore means is that, that should hold the share market where it is, if not propel it even higher.
And when you look at the US, if you want to look at a bit of history, low rates really kicked their share market along, didn't it? So, hopefully we'll go through that stage ourselves.
Yeah, so, and because you're quite right, we haven't had that recovery at all. Well, we've had a little bit of a recovery, but we still haven't even reached that GFC.
Not to the extent that those other countries have had, Andrew, no.
Absolutely. So interest rates falling, steady, soon to be falling. Great news for the share market.
So, Andrew, what are you buying?
Look, Dan, I've certainly been watching your Challenger recommendation of last week, and you were saying on Twitter, Rob...
Yeah, Rob was talking on Twitter about traders during the tech wreck, and they were talking about being stretched, and perhaps the market, that's where we are at the moment, a little bit stretched, Talking to a client with CSR yesterday, price earnings up around the 17 times on a 3.3% yield, and Challenger from last week, under 12 times price earnings and a 4% yield.
Yeah, so. And Amcor's another one, all of the, James Hardie, a lot of these cyclical based shares certainly are pricing in a big recovery if we don't see it. I've been buying Wesfarmers. I think Wesfarmers looks pretty attractive. It is ex-dividend, so you've got to wait 6 months for a dividend. And they're getting caught up in this sort of Woolies news. So Woolies came out last Friday, profit downgrade, increased the dividend slightly, so there was some small growth there, but the share price has gone from 34 back to 29. But
starting to look attractive again, though.
Yeah, 28.50 is probably the mark for those. So they're looking more interesting. But the big issue for Wesfarmers is that Woolies is losing market share. So there's a real concern that Woolies is going to initiate a price war. Woolies' EBIT margins, earnings before interest and tax margins, are about 18% relative to Coles at 8%. And that's because Woolies haven't invested in, they've invested heavily in infrastructure, like the warehouse out at Warwick, where it's all automated, but they haven't invested in labour. So labour, of course, is your most expensive thing. Coles have taken the other tact. We're all about service, labour, so that's why the EBIT margins are different. But it gives Woolies heaps of scope to actually go out there and cut costs, and that could impact Wesfarmers.
And that's what Coles did right from the word go, didn't they? When Wesfarmers took it over, they really got into the cost cutting.
Yeah, and also the service side. So Wesfarmers is certainly one that we've been buying. On the sell side, every week we normally say, sell this or whatever. A little bit of a different tack today, Dan.
Yeah. We're just having a look at the different indexes, Andrew, and seeing once again which of those are stretched, and probably a bit of portfolio reweighting as well. And, perhaps we should be looking at the financials.
Yeah, I know that from my own personal point of view, we were putting clients into, say, banks 3 years ago. Banks make up about 40 to 45% of the index. Of course, banks have done incredibly well over the last couple of years. And, my average client, if there is such a person, their portfolios are now 55, 60% banks. Far too high. Just on the growth, far too high. We're not suggesting banks are going to fall in a heap, but they are incredibly leveraged. So, if a bank has $100, so to speak, only $5 of it is their own. At $5 in equity, the other $95 is leveraged. Yeah. So when things are great, happy days. When things are not so good, and you can't really see how it's going to get much better for banks. We're talking about the economy getting slower, unemployment's on the rise. That's why the Reserve Bank is cutting interest rates. So we're just saying, now that everyone loves banks because they're all buying banks for yield, now is the time to be easing off of them. And what we've been doing, well, I've been doing anyway, is been buying things like BHP, things like Rio Tinto, things like Wesfarmers and, Woolies 2850, just reweighting people's portfolios. And I know you've been doing the same as well.
I suppose the other thing too, Andrew, perhaps we should be starting to look at those emerging leader companies again, because it's the cycle in the market, isn't it? Everybody's into the blue chips for yield, and then the money sort of flows into the next level of shares.
Yeah.
So.
And we were looking, you and I, the other day at InvoCare, and I think you were saying you had a client that paid like $4 and then they're like 14 today or something like that.
Well.
And so those styles of companies, they generally pay pretty poor dividends. They're there to grow.
Yes.
So what you need to be doing is once they have grown, take some of that money off the table and redeploy it.
Yeah.
So certainly, the sell for this week is look at your portfolio, look at your weightings, in particular banks and also emerging leaders as well. Anything else, Dan?
I think that's about it.
I think we're pretty right for this week. So till next week, thanks guys.
Thanks.